What is up, people? Miles here with Keep the Change. Today, we are looking at my $18,000 stock portfolio, so hopefully you guys enjoy. I think it'll be very interesting just to see what stocks I'm in and why, whether or not I want to buy them or sell them. And if you like the video, make sure to leave a like, okay? Lets me know that you guys like this sort of content, and I'll keep pumping it out for you. And also, make sure to subscribe if you want 2 new stock market videos every week. The last time I did an update on my stock market account was back in December, I believe, December 8th, I think. And I had around $15,000. So obviously the account has grown a lot by then. We'll be covering exactly why. So let's get right into it with our first stock here. Our first stock, we actually have Intuit. So Intuit's only 0.5% of my portfolio, very small position. I have an average cost of around $313. Now it's at $389. So obviously the share price has climbed quite a lot. And I'm actually up 24% or $13. The reason I love Intuit is because it's an accounting stock. So they own QuickBooks, they own TurboTax, Credit Karma, and I really believe they have a monopoly almost on these things. I mean, if you're doing accounting, you're going to QuickBooks. If you're doing taxes, most likely you're going to TurboTax unless you're like ultra Bezos rich and you have, certain accountants and tax people to do that for you, but most people are going to TurboTax. They also have a dividend. It's very small, it's very minuscule, but I thought I would just mention that. My problem here, the reason I bought so little is because I bought it because I thought the stock was kind of high in value and I wanted it to dip so I could buy more, but obviously that did not happen at all. So will I buy more? Not anytime soon, clearly, because I'm just waiting for the share price to go down just a little bit. I think the valuation's a little too rich, but great stock nevertheless, and I'm definitely hoping to buy some more in the future. Our next stock on the list is one everybody is going to recognize, regardless of whether you're a veteran in the stock market or you're completely new and have no idea what you're doing, and that stock is actually Airbnb. So I only have half a share, an average cost of around $150, and it makes up less than 0.5% of my portfolio. So obviously not a lot, and the total return is 34% or $25. Now, when it comes to Airbnb stock, it's a little hard to value at the moment just because their financials aren't really readily available. Also, it had its IPO very recently, so there could be a lot of volatility in the stock. They're reporting earnings sometimes in the next week. I'm definitely going to be doing a video on that, so stay tuned. But yeah, I just bought on the first day. I just bought a little bit just because I wanted a piece of the pie. I really do think that this company is groundbreaking. I think it's extremely innovative. Hotels are basically, they're in the past, okay? I think we can all admit that. And obviously the pandemic has hurt their business quite a lot. Nobody is traveling as much. You're not going to be booking Airbnbs, but I really do think that in 10 years, this is all just going to be a bad dream. Let's hope. So yeah, I'm definitely very bullish on Airbnb. I'm not buying at these prices. I want it to dip. If it went back to 150 or maybe even 100, I would definitely buy a lot more. Our next stock on the list is one I use on pretty much a weekly basis. I love this company. I love what they're doing. And if you're a student, you have most likely heard of them, and that would be Chegg. I've got 2 shares of Chegg. I bought it at $71, and it makes up around 1% of my portfolio, and I've actually made $70 or 48% back on my money. Chegg is basically like a one-stop shop for students in college or even high school, but usually college students, to actually get answers to homework or get textbooks or maybe just get tutoring in general. It's a great app. And on top of that, it's a subscription service, which is like one of the best business models out there. You just pay like $12 a month, and now you have access to all of Chegg's services. And even at $100 a share here today, I don't think it's a bad deal at all. I might bite the bullet and just buy some more, although obviously I do want it to go down before I buy, but hey, it might just never go down, so I might just have to buy it. So we'll see. I'm still, deciding what to do with that one, but yeah, I love that company, great stock. The next stock I own is in an industry I am extremely bullish on, and that would be the gambling industry, and this stock is actually DMYD, or Genius Sports. So I've got 23 shares, an average cost of around $11, and it makes up around 2.5% of my portfolio, and I am up $200 or 80% on the position. This is one of the best performing stocks in my portfolio. I think I bought this back in late November, and it's obviously gone up almost 100% since then, so I have nothing to complain about. And what makes this really interesting, especially for me, is that this is a SPAC stock. And if you know my investing style, I'm not a fan of SPACs. I'm not a fan of like EV plays or any of those high risk things, but this just presented such a good opportunity that I really couldn't pass it up. So basically, DMYD is going to be acquiring this whole company called Genius Sports. And what they do is they sell data from sports games to DraftKings and all these sports betting apps. So I think the revenue growth is going to be insane. I think it's going to be massive. And I think that that there's really no one else doing what they do, okay? Like, you can go buy DraftKings, but they have competition. Whereas Genius Sports selling data to DraftKings, they really don't have nearly as much competition. They have really just a couple companies competing against them. At $20 a share, though, personally, I would not buy it. In fact, I have been selling some shares, so keep that in mind, but I do think it's a great stock nevertheless. Our next stock on the list is a video game developer, one of my favorite video game companies personally, and that would be Take-Two. I own 4 shares, an average cost of $107. It makes up around 4.5% of my portfolio, and I'm up 90% or $394 on the stock. When it comes to Take-Two, there's a couple reasons I really like this company. Mainly the balance sheet. The balance sheet is amazing. They're loaded with cash and have no debt, and their brands, the IP they own, it's all amazing. They own GTA 5, one of the best-selling games in history. People still buy it. People still play it to this day. The end goal now isn't to get someone to buy GTA. The end goal now is to get someone to buy GTA, hop on online, and buy shark cards or microtransactions. This makes them extremely profitable. The revenue growth is going to be massive in the future. I think Rockstar Studios is one of the best game developers ever, so I love this stock, love this company. I'm not buying more at the moment, but if it dipped down to like 190, 185, I would definitely purchase some more. Our next stock on the list is another video game company, so we're keeping with the same theme here, and that's Activision. I actually thought Activision was an extremely undervalued stock when I bought it, so I bought it at around $54 a share, and I have 14 shares, and it makes up around 8% of my portfolio. I am up 84% or $655 on that position. And the reason I bought Activision is because of the strength of their titles, of their games, and just how diversified they are. So they own King Digital, who makes Candy Crush, which actually a lot of people still play. They own Call of Duty, which obviously is huge. Okay, Warzone is big in itself, and Call of Duty Mobile's coming. There's a lot of bullish reasons to be happy about that whole side of the business. And then on top of that, they own Blizzard, they own World of Warcraft, they own just so much stuff, I can't even name it all. They also pay out a good dividend. The stock is not quite as undervalued as it once was. I think it's approaching fair value here today, so I am considering selling some, but obviously I'm not selling some anytime soon. I'll probably just hold, and yeah, that's where I'm at with the company. And the next company on the list is one that billions of people use on a daily basis, and that would be Facebook. And if you don't use Facebook, you use Instagram or WhatsApp. I own 6.3 shares. I bought it at $184, and it's around 10% of my portfolio. I am up 44% or $525. Now, when it comes to Facebook, there's not much that needs to be said. It's probably one of the most reliable, stable companies out there in terms of profit, in terms of revenue growth, just across the board, an amazing company. The valuation is extremely fair. The balance sheet is amazing. No debt on this company, tons of cash. Definitely going to buy more in the future. I want to see their earnings as well. Should be very excited for that. And yeah, so that's my feelings on Facebook. This next stock on the list is one of the most undervalued stocks in the entire market, in my opinion, and that would be Alibaba. I own almost 7 shares, an average cost of $179, and I'm up 46% or $580. When it comes to Alibaba, they're definitely compared to Amazon. They're like the Chinese Amazon. That's what most people say, and that is true to an extent. They're a little different, but the idea is essentially the same. They're basically the biggest e-commerce platform in China, but that's also really minimizing the business and overlooking a lot of key components that goes into it. So they also own Alipay, which is the biggest payment service in China. If you want to pay for something, you're going to be using Alipay. They take a little percentage of that. Easy money, amazing, really makes their whole ecosystem very fluid. They also own a cloud business. So a lot like Amazon with AWS, their cloud business is actually growing at massive rates. And personally, I actually think Alibaba is probably a better deal than Amazon at the moment, but there's definitely a discount because they're Chinese. You know, can you trust the financials? It definitely gets called into question. I'm going to be buying some more soon. I want to get to 8 shares, so yeah, let's make it happen. Love Alibaba, great company, great stock. This next stock on the list is one that I absolutely love. I found out about the stock in mid-2020, and I've loved it ever since. It's my golden boy. It's my personal favorite stock pick that I've ever made, even though it hasn't had the highest percent return, but I think in the future it definitely will, and that would be GAN. So I have 62.5 shares, an average cost of around $20, and it makes up around 11% of my portfolio. I've made $677, and I'm up 54%. So let's say you're a casino and you want to open up an app, but you don't necessarily have the technology or the manpower or yada yada. So you go to GAN and they say, hey, we'll design this app for you, but every time someone makes a bet, we get a little bit of money, a little bit of a commission, if you will. And so their revenue growth is absolutely astounding. They grow their revenues at 100% a year so far, and that's honestly amazing. And this is a very recent company, came out last year during the pandemic. So yeah, I love Gang, great company. If it dips, I'm definitely going to buy a lot more. I want to get to like 100 shares or something. I would feel very comfortable with that. Our next stock on the list, everyone knows, it's Visa. I've got 10.15 shares, an average cost of $155, makes up around 12% of my portfolio, and I've made $530 or 33%. Great buy, great purchase. The reason I haven't bought more is just because it's such a large part of my portfolio already, but I definitely love it. I definitely love the fact it's in my top 4 stocks. So this is where things get interesting, guys. These are my top 3 stocks. So starting at the lowest one, my third biggest holding, that would be Amazon. So I have 0.64 shares of Amazon, an average cost of $1,824, and I'm up 81% or almost $1,000. Love the company, great stock, and I'm definitely going to buy some more. This next stock on the list is my biggest loser by far ever in my stock career, in my history, and it's Momo. So I have 142 shares, an average cost of $24, and I am down 31% or $1,100. In its simplest form, Momo is basically a Chinese live streaming app, and they also own Tantan, which is essentially the Chinese Tinder. And I bought this company way back in like September of 2019, I believe, right before the pandemic started. I believe I bought it around $30 a share. The pandemic started, and it obviously tanked quite a bit, all the way down to $13. In terms of buying it, I do think it's a buy at this price, but for me personally, I already own too much of the stock to justify purchasing more. I do think though in 2021, the share price will have massive gains. We'll just have to see though. Those are my thoughts on Momo. Good company, good buy, but definitely very risky, so be careful with that one. And my top holding in my portfolio is one that everyone knows, Microsoft. I've got 11 shares, an average cost of $120. It makes up around 15% of my portfolio, and I have a total return of 99% or $1,300. Great stock, great valuation, constant growth, constant revenue growth, also constant dividend growth. Amazing company. That is why it is my number 1. Now we're going to look at my overall returns for the portfolio in the past year and all time. Portfolio is worth $17,800, so maybe not quite $18,000. I did a little bit of clickbait there. Okay, can you blame me? But I am up 15% this past year. I've made $2,300. And compared to the S&P beat me by 3% in the past year. So obviously, if I didn't have Momo, I probably would have beat the S&P, but that's okay. That's fine by me. You know, I'm just long-term holding here, no problem. And for all time, I am actually up 19% or $2,800. Let me know what you guys think of the stocks in my portfolio, and let me know what stocks you like personally from this portfolio. So yeah, guys, make sure to have an amazing day, and I love you.